Regional banks are still under siege while inflation appears to be under delivering. Let's talk about that today on this episode of SRT Live. I am your host, Sean Richard, with the Sean Richard Mortgage Team. Thanks so much for joining me. I'm excited to talk to you today. We've got a lot of information to cover, and we've got some critical information, economic data coming out tomorrow and Thursday that has the potential to have some significant impact on our housing and real estate market. So let's get into it. As always, we're going to start with the week in review. So last week, again, a slew of information. On Wednesday, we got the ADP private payroll report. Now, ADP has changed how they calculate this as of several months ago, and there's still some debate on how accurate this is. But ADP forecasted that there was going to be 148,000 new jobs created for the month of April, and it came in with a whopping 296,000 on ADP's report. Now, fast forward to Friday, we got the BLS, the Board of Labor and Statistics Jobs Report, showing job creation for the month of April. And in last month, we had a very solid alignment between ADP and BLS. BLS expecting 179,000 job creations. We got 253,000. So just like the ADP report, we saw a significant beat on jobs report. Now, this is not ideal news. One of the components that the Fed has been looking for is a little bit of a softening in the labor market. I've been screaming it from the mountaintops every week, and that type of a labor market is putting pressure on inflation. We talked about wage pressured inflation last week, and we saw that in the jobs report. We dig a little bit deeper. Hourly earnings on last week's jobs report rose 0.2% higher than expected month over month. Market analysts were expecting 0.3% month over month increase. We got 0.5% or 0.5% month over month increase, bringing the year over year number to a 4.2% increase in hourly earnings. So this is a big deal because this is wage pressured inflation. This is creating higher costs for companies, which then have to increase costs in the marketplace. And therefore, consumers like you and me are paying these higher costs. So the Fed is looking for a softening in the labor market to help with overall inflation. Now, last week we had the Fed meeting on Tuesday and Wednesday, and on Wednesday we got the Fed's decision on the Fed funds rate. They raised the rate to 0.25%. So now they're in the 5 to 5.25% target range. And this was expected, but also a little bit surprising. The Fed has done a lot of increases to the Fed funds rate over the last 6 to 12 months. And several market analysts felt like this was not needed, that the Fed could stand pat where they were and give their previous rate hikes time to take effect. However, the Fed did elect to increase the Fed funds rate. Just as a reminder for all of you watching, or if you're watching for the first time, the Fed funds rate dictates or is directly connected to short-term lending rates. Ultimately, the Fed funds rate is your overnight bank-to-bank lending rate. And so it's going to impact products like credit cards. It's going to impact products like auto loans, other unsecured products like lines of credit, or anything tied to prime rate, because prime rate typically moves with the Fed funds rate. So those are going to be the lending products that are impacted by a change to the Fed funds rate. Mortgage rates, however, are not directly tied to the Fed funds rate. And in fact, an increase to the Fed funds rate typically is designed to help mortgage rates because it's designed to combat inflation. Across the pond, we also saw the ECB, or the European Central Bank, with their rate decision. They're the equivalent of our Fed. They also raised their rate to their standard rate to by 0.25% as well. So we're seeing increases to central banking rates across the globe to combat inflation. We are definitely not the only country that's suffering from inflation. As always, last week on Thursday, we got jobless claims. So these are unemployment claims. We get initial claims, which is individuals filing for unemployment for the first time, and then we get continuing claims or individuals renewing their unemployment benefits. And this is an important report that we keep an eye on because this lets us know part of the health of the labor market. I've talked about it in length in previous episodes, but the sequence in which we see employers, they hire, they freeze hiring, then they cut hours, and then maybe they finally let people go. So what that means is when we start to see an increase in the unemployment claims, the initial claims, that is really the last shoe to drop. And that would be a great indicator that we are finally starting to see a softening in the labor market. There's several other reports that give us some preliminary indicators, some advanced indicators like job openings or even continuing claims. But initial claims lets us know kind of on the tail end that, hey, this is actually happening. So with that, initial claims came in at 242,000 new claims filed. This is a week over week number. This is up slightly from the previous week at 240,000 and also up from this was up from the previous reading of 229,000, but in line with expectations, about 240,000. Continuing claims, we continue to hover above the $1.8 million mark. We were at 1.805 for this reading. This was down from the previous reading of 1.84 and lower than expectations of 1.86, 1.87. So we're seeing continuing claims decline a little bit, which also reflects strength in the labor market and the tight labor market. Let's see. We also saw the unemployment rate tick down slightly from 3.5 to 3.4%. A little unexpected there. That's going to happen when we see kind of a blowout jobs report, and that was kind of the cherry on top for just really illustrated or highlighting just how tight the labor market is right now. Now, fast forwarding into this week. So yesterday and today, pretty low key start to the week. Not a whole lot going on, but we're going to finish the second half of this week with some gangbuster information. Starting with tomorrow, Wednesday, we're going to get CPI, which is Consumer Price Index. This is inflation at the consumer level. Now, there's a big hope that we're going to see this come down. We really want to see inflation trending on the downward side, but there's a little bit of a debate between market analysts on which direction this is going to go. We're also on Thursday going to get our jobless claims, as we always do, but we get another inflation report in PPI, Producer Price Index, which is inflation at the wholesale level. Now, that gives us a little bit of a glimpse into what we potentially could see in the Consumer Price Index report going forward. But remember, wholesale or producers don't have to pass all of that extra cost onto consumers. So they're not going to move in lockstep, but they tend to be trending in the same direction. And then on Friday, we get the University of Michigan consumer sentiment. How's everybody feeling about the economy? We're going to talk about that next week. So what are we watching going forward the rest of this week? Well, number one is inflation. We've got CPI and PPI data coming out the rest of this week. And it's been a mixed bag, as I mentioned, a forecast. If CPI comes in lower than expected, inflation cooling faster than maybe analysts are expecting it to, then we're going to see that translate into great positive movements in interest rates and mortgage rates. If we see CPI come in hotter than expected, then we're going to see mortgage rates pull back and we may see them rise back up a little bit. So that's going to be something very critical that we're watching tomorrow and Thursday. And then secondly, the second thing that we're focused on is the turmoil in regional banking. Regional banking has apparently taken the driver's seat. Inflation is now sitting in the back seat watching, and the drama in the banking industry doesn't appear to be completely over. Let me show you this real quick. Let me pull this up. There we go. So this is the KBW Regional Banking Index, and this is the 5-year. You see here, this is a 5-year view So this is where we're at right here. We're at 79.48. You don't need to know a whole lot about this, but what you do want to pay attention to is this is the lowest level that we have seen this index since, look at that, September of 2020. So that's pretty critical. Back to 2020, when we were right in the middle of the pandemic, that has been pretty critical. So we're not out of the woods in the regional banking sector yet. There may be some additional shoes to drop. The market feels that we are still in the middle of the drama with regional banking. So let's watch that. But that's going to take priority over the inflation reports this week, most likely. And then once we see that stabilize, we'll be back to focusing primarily on inflation until we get some more, until we see some more housing data and the next Fed meeting in June. All right, gang. I hope this has been a great resource for you to really understand what's going on in the economic markets and how it influences our housing market and the mortgage rate environment. If you're a buyer or a seller, just know that the housing market is almost always completely resilient. We've got a few periods over the course of time where housing has declined, but in general, housing is always moving up. But sometimes it kind of does one of these. It'll flatten, every once in a while it'll dip, but then it tends to go back up. So if you're thinking of buying or selling, definitely contact your favorite real estate agent. And then, of course, if you're financing, there's a good mortgage team that you probably, I guess, need to check out. I'm going to get the hang of this whole hand thing at one of these days. But I appreciate you joining me today on this episode of SRT Live. If you are checking us out in the private Facebook group, thank you so much for being an incredible part of our community. And if you're watching on our YouTube channel, be sure to hit that subscribe button so that way you've got up-to-date real estate, economic, and mortgage information at the palm of your or at the tip of your fingers. All right. Well, gang, I appreciate it. Leave any questions down in the comments below, or you can always reach out to me at there I go again, the contact information here. Have an amazing rest of your week. Thanks for joining me today.